All investment strategies have advantages as well as some disadvantages, and international diversification is not left out. So I want to consider the risk of international diversification when it comes to investing. Number one here is currency risk, because you deal in different currencies, different countries use different currencies. And so once you diversify internationally, you have to factor in currency risk. And so fluctuation in exchange rates can impact the value of foreign investments. A strengthening domestic currency may reduce the value of returns from foreign markets, while a weakening domestic, currency could enhance them. If in Nigeria here, you're in Nigeria and you invest in the US, you discover that the exchange rate fluctuation is quite notable. As I'm talking, I think it's around 1,700 plus thereabout. Okay, so the higher the US dollar, is going, the more money you make, as a Nigerian investor. Whereas if the dollar is kind of down, the lower amount of money you make as an investor from Nigeria. And so this currency fluctuation is key when it comes to investing internationally. Number two is political and economic risk. So political instability, government policies and economic conditions in foreign countries can negatively affect, investment returns. Issues like nationalization, trade restriction, tariffs, or corruption can add significantly to uncertainty. Some countries can decide to nationalize, a company. So that's a risk we must consider. Though it's not all that common nowadays, but factors like trade restriction, like higher tariffs, and all those things could come in to affect an investor that choose to diversify internationally. Number three is geopolitical risk. Talk about wars, talk about conflicts, sanctions, or trade disputes can affect market in specific countries or regions, potentially leading to losses or volatility in international investments. And so you invest in a country that is facing instability, maybe war, maybe sanction, maybe natural disaster. All these things can affect one's portfolio, can affect one's investment returns. Number four is regulatory and legal risk. When it comes to different countries have different regulations and different laws. So different countries have varying regulation when it comes to taxation, market transparency, corporate governance, and investor protection. You consider all these things. How transparent is the financial reports the companies, listed companies issue out in those countries. How transparent are they, and how strong are the regulatory agency in those countries? So you have to factor in all these things. Number five is market access and liquidity risk. Market access and liquidity risk. Some international markets may have lower liquidity. That is, you cannot very easily buy or sell assets without impacting the underlying prices. And so capital control or restriction on foreign investment can also limit market access. Some countries may restrict foreign investments. They may have laws that are designed to hinder capital flights. All right, so foreign investors may not want to come in, and all these things are taken into consideration. Number six is economic cycles. So different countries experience different economic cycles. The economy moves in cycles, and definitely it will also affects investment in those countries because the economy is always tied down to they move in tandem with stock market performance. And so if the economy is down, it's in a downward trend, it will certainly affect the performance of stocks in the country's stock exchange. And not only that, you discover that there's this you know uh, there's this you know this concern over higher cost. Number 7 is higher cost. So investing internationally can lead to a higher transaction cost, such as higher fees for foreign transactions, taxes as well as commission. Fees could be higher in foreign countries compared to your own home country. So this cost can reduce, one's overall returns on investments, definitely. So the kind of fees like in Nigeria, there's nothing like capital gain tax. I don't know whether it will come in the future, but now it's completely absent. They only tax your dividends, all right, and they tax your trade. When you execute trades, there's a level of taxation in your trade, but as per capital gain tax, I don't think it's applicable. I've not really observed, but I don't think it's applicable, in Nigeria here. If you feel it is, please you can indicate in the comment section. I don't think I've really observed that. Number 8 is cultural and communication barrier. These are cultural differences. We must take note of language barrier, different time zones, why it is night in your own country, it is daytime in another country. So you have to time your trade to correspond with the time of activities, or the daytime in the country you are investing in, because of the difference in time zone. You equally need to learn other people's culture. It's very important. And so this may complicate the process of managing one's portfolio when it comes to international investing. Number 9 is emerging market risk. Emerging markets are known to be risky. They have high volatility. They have lower market maturity. There's greater vulnerability to economic or political shocks. These are critical characteristics of a typical emerging markets or emerging economy. And so number 10 is investment restrictions. Some countries impose limits on foreign ownership of companies or sectors, restricting the ability to fully participate in certain markets or industries. Some countries, they may not allow foreign investors to own, the shares of a domestic company beyond certain limits. They may peg the limit above which foreign investors will not be allowed to own shares in those countries. I discovered that why this particular event is quite profitable and proficient. It has this drawback I've just considered. So it's noteworthy. We consider this as individuals who are keen on diversifying our investment internationally. So you consider the fact that the country's economy will impact your investment, the political risk, could equally come in, the culture of the country could equally be factored in, as well as some currency risk. More importantly, the currency risk is something one cannot really ignore as a global investor. So consider this advantage. If you feel you can still cope and go ahead, good and fine. But it's necessary you diversify your portfolio away from your home country to be able to mitigate risks that are inherent in your own country as an investor.